Good morning, everybody. Welcome to the Flow Show. It's Tuesday, and we're kicking off another session. Morning, Kay.
Good morning, Ryan. Good morning, everybody.
How you doing, mate? All right?
Yeah, very well. Thank you. Bit quiet.
Yeah, it seems quiet. I was out yesterday afternoon, as you know, and it looked like I missed much.
No. A few data. I guess we're going to talk about those, but all in all, we are settling a bit. Yeah, it's a bit of transition, I think, before what's to come. Big earnings week, central banks, Rishi Sunak and his budget. So
Month on top as well.
come again.
So end of month coming as
And
well.
end of
So
month coming as well. So market is taking a little bit of a breather, it seems.
yeah, definitely. Well, let's crack on with the bits and pieces. Not too much out, actually. We'll start with China. They really let the F.A.C.E go overnight. We can have a look at CNY, but we look at CNH as well. So the last fix, Monday's fix was 7.1230, and they fixed at 7.1668. So that's one of the biggest jumps for quite some time, I believe. Now they also, their FX regulator was apparently asking banks about their views and positioning in FX markets. This has come as allegedly traders were maliciously shorting the yuan. And they made it clear to banks that this survey was urgent. Now, it hasn't done anything to halt the yuan weakness. So one has to wonder what exactly they're looking at here. We have had warnings previously that obviously yuan moves weren't going to be one way, that sort of thing. But they don't seem to be doing anything at the moment strongly on this. And this is coming as well as some talk that they're well, I would say intervening, but they're getting banks to buy up stocks. Something we heard about coming before the party's Congress. You know, this could be just part of all that they want to keep markets looking rosy into the Congress and then immediately afterwards. But obviously, this does have ramifications for trade, particularly with the US, making their exports much cheaper. What do you make of it, Kay? They're not really got a lead on it at the moment, have they?
No, and I'm not sure whether it's wanted that they want the yuan weaker, but for sure the move in the fixing is clearly an indication that they are catching up to the market instead of the opposite. So yeah, the dollar CNH market, the offshore market, took it as a green light to take dollar CNH another leg higher, and they can ask people to make their reports, and perhaps we are going to see type of interventions where they are going to put dollar yuan lower. But for now, seeing that they want to get their economy better again, wanting to help or bailing people out, I don't think it'll have any lasting effect. A little bit like what happens in the yen, and as long as they don't really show the market in both on and offshore markets that they want to put a cap on it, I think the speculators will continue to sell CNH. It's still the weak side, right? Yeah. So yeah, and they don't seem to, well, in words, they might be talking about it, but then in real actions, but it's going to be easier for them to cap the dollar CNY than to cap the dollar CNH, right? The dollar CNH is supposedly a free market, but until they say it's not anymore.
Exactly, and you know, you're right, but you know, anything they do in CNY is going to reflect in CNH. The reason I think we like trading this one is that you do get the clear signals from officials, it does put tops and bottoms in play, and then those are pretty tradable. I wouldn't try picking a top now, but if we start to get comments where enough's enough, that's the time when I'll certainly be looking to jump in and fade the move, at least until that rhetoric runs out of steam.
And looking at your chart, is that the CNH or the CNY? CNH.
That's the CNH.
Yeah, I think you can put a second blue zone a little bit higher now between these 722 and 725. That could be the next. That could be the first like really decent level now, decent zone, because on the comments that they gave and on the so-called interventions, we put lows in there around 721, 22. And and that happened when we started to shoot over 725. So this 22.25 is the first nice zone, I think, where we should pay a little bit attention to what happens if we ever get back in there. And it's about, well, it's already 1.5% away, but considering it's a relatively fast-moving market, that's going to be the first interesting zone now for me.
Yeah, there you go, mate. There's a zone just for you.
Yeah. Hello, testing 1, 2, 3. Can you hear me?
Hey.
Hello, Steve.
I hear you.
Yeah, no, I'm in as Steve. I'm not Steve.
Steve. I always love it when you do a Steve impersonation.
Yeah.
Steve's in the kitchen.
Okay. Okay, all good, all good. I'm doing all of Steve's stuff this week, so I'm trying to get everything in line, and I think we're okay. So, how are you guys doing?
Yeah, we're all good, mate. All good. All good.
Right.
Just talking about the yuan and the mess that's going on there at the moment.
Yeah. Okay. It looks like the only thing moving really today, I mean, okay, we do have a little bit of risk off, but really the only thing moving is metals again. Like yields are not going higher, they're going lower. The dollar is flat. And yet everybody hates metals again. I didn't expect that ahead of the FOMC, but you know what they're like. Up 3% one day, down 2% the next.
In a world of their own at times.
Yeah. Yeah.
Cool. I think it's a bit the global picture, right? You have the dollar. We are waiting for the FOMC. We're probably waiting for what's going to happen in equities on the back of earnings this week, and then you have all the rest. I mean, what do you do with the other side of the dollar pair, right? We were just talking about the yuan, and where the dollar doesn't really move that much this morning, the yuan is how much? Is like nearly 1% weaker again. So
yeah, there is stuff moving around. Well, let's crack on with the rest of the headlines. The usual Japanese voices out with their usual bluster about FX. People keep trying to put a number on the intervention, and the Nikkei was out overnight with their traders' estimates, if you like, reckoning that $37 billion was spent on the last intervention, which is pretty much, give or take, double what came around in the first bout in September. So a bit of a step up there. They are facing a situation where they have to spend more to do less, if you like. Each intervention that comes along is going to wane, as we can see from that last one. If both of them really have washed out pretty quickly. So they may look to switch. I know a few people in the market are talking and theorising they may switch to more shorter term, smoothing type intervention rather than hitting the big volatile moves. They can change the playbook around. They will need to change the playbook around if they're going to do this effectively. But they're still, their number one goal is to reduce speculation and volatility. So while they do that, they're on the right side. But as we saw, it didn't last too long back in September. We did get, maybe a week and a half, 2 weeks of quietness before it all kicked off again. So it all depends how the market sees it and what the Bank of Japan are going to do. Do you reckon they'll change it around, Kay? Maybe just pull out? Because there was actually a comment from before that. There was actually a comment from Yellen saying that Japan hadn't told them about this intervention as they did in September.
Oh, yeah, but I mean, they probably assume that the U.S. Treasury knows that they will continue to intervene. I'm not sure whether they're going to call them every time with a warning.
Yeah,
Well, as we've seen in September, it was around 145, and then we pushed over to 100, above 150. They clearly didn't like that one. Clearly didn't like the speed. Yeah, now it's now the question is indeed are they going to start to defend 150? So we'll have to see what happens if we get there. And I think all else equal, and assuming that the FOMC is not going to pivot yet, and Bank of Japan keep things as they are, I think they are going to have to get ready for a fight, because the fundamentals are still very much against the Japanese yen. And I've also read that importers were still very active. I think those people have been a bit taken by surprise as well, because the rest of the market went a lot harder than what they expected to hedge. So they seem to have been a bit behind on their hedging scheme, and I've heard that they had been busy in the market again, and that's probably one of the reasons why after every intervention you've got natural bids coming in, and as long as those natural bids come in, it's going to be hard to bring dollar yen, to hold dollar yen materially down, in my opinion. So I guess the retest of 150 is just a matter of time.
Yeah, we shall see. Now, speaking of Yellen, she was out with some comments saying the US economy is healthy and the financial system is resilient and that credit quality is good. That's probably a signal to short the shit out of the US if they're coming up and saying everything's so fine and dandy. But the main context of her comments were around liquidity in the bond market, and that they may look more as a preventative after seeing maybe what's happened in the UK. They may look for measures to support liquidity in the bond market should it be needed. Now, this is probably the second or third time she's commented on, keeping an eye on the bond market for liquidity and stress and stuff like that. So I wouldn't go so far and be a conspiracy. I'm saying the word now. Conspiracy. Oh, I can't get. What is it when you're a conspiracist?
Yeah,
you're a conspiracy theorist. That's what you are.
Conspiracy theorist. That's the one. That's the one. I won't go that far to say that there are problems in the US market, and that her comments are maybe coming ahead of potential problems, but they are looking at preventative measures if there are problems. It doesn't take the market much to jump to the wrong conclusion on that, and then we start to see yields pressured and so on and so forth. I still maintain that moves in yields up, as we've been seeing in particularly US yields, are okay as long as they don't start breaching the Fed's expected rate ceiling. If we start seeing yields going above 5% and it's not led by a more hawkish Fed, then we're potentially smelling some problems coming into bond markets, because they are then pushing a premium on top of yields above where rates are expected to go. Now, it should be said, the interest rate yield levels sometimes can be a little bit loose. It's not, if rates are 4.5%, it's not necessarily that all yields go to 4.5%, that sort of thing. But you get to see sometimes when yields are pressured, like we saw in the UK, when other factors come into economics, into the fiscal situation, whatever. So yes, a warning there from her. As we know, Sunak is going to be the new UK Prime Minister after the other runner, Penny Mordaunt, pulled out. He's already said there's not going to be a general election, and he will announce, or he will decide on whether to announce this fiscal plan October 31st. So that's going to be something to watch at the end of the month, whether he goes with a plan that's already put in place, chops it up a bit more, changes it around, reverses it, goes the opposite way, whatever. That's also still going to be a big effect on what the Bank of England do, and something that BOE members have been talking about, depending on this fiscal package and how it turns out, could influence their rate decision a few days later. So we need to keep an eye on that. Looking quickly at some of the data, and then I'll bring the guys in if they've heard any other bits and bobs. US services pretty much following what we saw in Europe. Quite some steep declines there. Manufacturing into contraction once more, 49.9. Services further into contraction, 46.6. Quite a drop there. So we are seeing these PMIs starting to flag some potential problems in the different sectors there. It's still yet to be followed up by some of the hard data, which obviously lags quite a bit. But we are getting the signals now. It could be a case that the Fed reflect on this data that we're seeing, and maybe we get this decider that this 75 pip hike is the last one, and then they're going to look to scale down. Doesn't mean they're going dovish, doesn't mean they're going to pivot. It just means they're getting towards their ceiling, and the crunch is going to be how long they say they're going to sit at that ceiling for or keep rates high. It's not about the pivot for now. I can't see them doing any sort of pivot or announcing they're looking at any sort of pivot. But that's to come in a week and a half's time. Lastly, and this is one for you gold bugs, from Goldie's, Goldman Sachs, said that gold could rise to $22.50 on sizable US recession, or it could drop to 1,500 under an ultra hawkish Fed. I don't know how much more hawkish that an ultra hawkish Fed.
Or it could go sideways. So there you go.
Or it could go sideways between 250 and 1,500. Yeah. So that was Goldman Sachs with their forecast, sitting on both sides of the fence, or leg on each side of the fence, whatever way you want to look at it. Handy analysis from those guys as usual. Gents, you got any bits and bobs you want to throw into the mix? Any good headlines you've seen or points you want to raise?
From me, big no. It's a no from me, as Simon Cowell would say. Sorry.
Over to Kay.
Yeah, as I was saying this morning in the chat room, it's been extremely quiet on the market moving front, at least overnight. The only stress point is still Russia, Ukraine, because now the one is warning about the other, about possible dirty bombs. So that's a bit of a stress situation that we keep an eye on, because if anything really gets out of hand there, more than it is right now, yeah, that could have an impact on some markets, especially if it goes dirty. And for the rest, really, it's been extremely quiet. So we just know that Goldman Sachs is bidding 1,500 in gold and offering at 2,200, and or 2,150 and bidding 1,550 probably for when their followers give them at the lows and pay them at the highs. No, for the rest, it's been extremely quiet, and also the markets after the Friday and Monday morning swings is also quieting down a bit. We'll have a look around, but it's going to be a fast one today, I think.
Yeah, sure. Stel, you got any charts you want to have a quick look at while we're on the subject of gold, and that gold
yes.
is, as we say on the floor, that quote is wide enough to drive a bus through. So
yeah, beep, beep, beep. Yeah. Yeah, sure. I'll show some charts. They don't change much from day to day, but I think once a week is not a bad idea to do. So can you see my screen?
Yeah.
Okay, perfect. So I always start my day by looking at yields, because I still think that yields are driving everything. So by definition, the Fed is driving everything. But I think we already knew that. So 10-year US down from the peak, which was 433-ish or something like that. So we're still kind of consolidating here. But if you look at the big picture, this is a pretty nice kind of, channel-y thing. You know what I'm trying to say, something like that. So we're still on an uptrend, pretty clear uptrend. We did have a nice little bullish flag there. We might get another one going into the Fed, but bottom line is yields are not dropping. Yes, they're off the highs, but really this looks like consolidation to me. So as a result, if yields are not dropping, That means that the most likely scenario is they go higher. Obviously, the Fed can stop this scenario by being dovish on November the 2nd, which I doubt. I think they're going to start being dovish early 2023. But I think this meeting, they're going to continue. Powell is going to continue what he's saying because, let's face it, the markets are not collapsing yet, or neither is there liquidity issue like the UK, for example.
Ask you a question, mate.
Yeah.
You say they may turn dovish. I mean, I get this a lot. I hear this a lot. It's they see the banks as either hawkish or dovish. You know,
Yeah.
What about just neutral?
Yes, of course they could do that, but I think for me, if they turn neutral, which I would define neutral as them saying, look, we're done with 75s, we're going to go at a slightly slower pace, I will take that, and I think the market will take that as being dovish, because that's the first step towards saying, yes, we're done. At least in the short term. So if Powell comes up with this meeting and says we're hiking 75 and probably going to be doing another 75 in the next meeting and doesn't indicate that the pace is slowing, I think that's hawkish. Anything else, the market is going to take as dovish, and I'm going to take it as dovish, at least in the short term. So that's what I'll be looking for. So if yields are going higher, then risk will go lower. I think that's broadly what we've been seeing. And remember when we were rising and rising, 2018, 2019, 2020, before COVID, when we were having rallies every day, even though Trump was, fighting with the Chinese on trade wars and all that, and it was just going up. Well, we used to say at the time, things are overstretched, but rates are zero. We're doing QE. Borrowing is cheap, so companies were issuing bonds and doing buybacks. So we said at the time, if and when yields go up, this has to reverse. So this is what we're seeing here. And this remains my view. I think we're going to get to 3,300-ish, which was a pre-COVID highs. And I think that's going to coincide with the Fed turning and probably early next year. And this could well be the low here. I know a lot of people are looking for a lot lower, and for people who joined the Traders Summit we did last weekend, I think the majority, the big majority of speakers were bearish the markets, and that kind of scares me a little bit. I think at least for the short term, for the next weeks, months until we get the Fed turning, I think the bias is to go lower in equities. Now, that doesn't mean that we can't rally more into the Fed in November. I think we will. I think we will probably get towards, I have talked about 3,900 for a while. I think we're going to probably hit that going into the Fed. Now, what happens on the day of the Fed, that's a different story. So that's what I think about risk in general. And then you have things like which are correlated with risk. So you have the dollar index, which is, yes, consolidating here, but we're still on an uptrend. And this is the same as yields, kind of same picture, higher highs, higher lows. So until that is invalidated, the trend is higher. And I don't think we should be going against it. We talked about it so many times. You try to pick a top or a bottom, you're going to get hurt. Okay, maybe once you're going to get it, but 9 times out of 10 you're going to get hurt. So you want these odds? I don't want them. So the dollar is going to keep going, I think. And then you have other risk proxies. You have cryptos, which are, Bitcoin in particular has been just hugging this 18 to 19K area for ages, and this looks bad for me. I mean, this looks bad. And if Powell is not dovish, as I think he will not be, then this is going to break. And when that breaks, we're heading towards 12K. This is the next zone, 10 to 12. And,
where's your mate's next stops?
Michael Saylor.
Yeah.
I don't know actually what's happening there, but they're already massively underwater on those. The question is, when do they need to post more collateral? When do they actually need to make trades to get out of this? I don't know that. I mean, I don't know. But I'm guessing we're getting close.
Is he on missing in action now? It's this low, or is he still pumping and screaming?
Yeah, I haven't seen much from them, but I don't know. It just doesn't look good at the moment. It doesn't. Then you have other assets which are correlated risk, which is gold and silver. And gold looked like it might be doing a double bottom here, but I said before, I'm not convinced. The Fed is going to be a huge driver, and trust me, if they're hawkish or if they're not dovish, this is going to break. And when this breaks, then we go down to 1550, something like that, 1530, 1550. That's the next area of interest. So people who follow me, they know I'm very, very bullish in metals, but I'm not pulling the trigger yet because I think we're going to get better entry levels. If you ask me if I take a trade and close my eyes and open them in 2 years' time, I think we're going to be a lot higher from here. But you want to get the best entry as possible. Silver is the same story. Was trading slightly better, but look, it's the same thing, consolidating here. If the Fed's hawkish, we're gone, and then we're going towards, I don't know, low 17s probably. So we need to be careful. We need to be we need to be aware. If you're taking a trade here which is correlated with risk and the dollar into the Fed or over the Fed, you are taking a bet on the Fed. If you feel comfortable doing that, great. If not, I would suggest lightening up positions ahead of the FOMC. So that's my views roughly. I hope it's helpful, and yeah, let's see what happens.
Yeah, thanks, mate. And there's a question there from Paul saying, any relationship between CNH and gold metals? Yeah, there's obviously a fairly strong relationship.
I'm going to pass you the screen, Ryan. Okay. Sorry.
Yeah, thanks, mate. Yeah, there's obviously a strong relationship because China is a big commodity importer, particularly in some of the precious metals. Obviously, the relationship between them and countries like Australia. So yeah, there is, because obviously if you've got particularly recession worries, global recession worries, that's going to impact the price of commodities, and obviously what's happening in China, which their economy is, well, if we're to believe the numbers that we got the other day, their economy is doing fine, but we know the actual situation is different in it, and there are softness signs there. We know we've got problems in the housing markets, property markets, building, that sort of thing. So there is a strong relationship, but it's more something you want to perhaps look at in terms of global growth or Chinese growth ways, if you know what I mean there, Paul. Kay, do you want to grab it and have a little look round?
It's going to be quick today.
It doesn't sound too convincing, but yeah.
No, because I don't have, hold on a minute. I don't have really much to say today because we are trading ranges, and we have already talked about the ranges, and they are just still there, like euro dollar. As long as we are below this 99.5-ish, add parity to it, and above these prior 97, low 97, high 96s, we are waiting for ECB and the FOMC thereafter. So to me, if you want to trade it, respect the edges, buy low, sell high. Sorry, the opposite isn't good for your account. But I don't have really much to say on there. The one Ryan already showed, but the dollar yen is still just in an uptrend. Yeah, we have intervention spikes lower, and people have been playing them, have been making money out of it, and really, really good on them. But we see though that certain levels are holding, and to me, for as long as the Fed doesn't pivot, for as long as now we are seeing actually US data as well starting to show weaker numbers, but then put against it, the Japanese numbers aren't great either. They are in a negative trade balance, and their current account is negative. And you have, as my old record keeps on saying, is that we have the Japanese government putting in stimulus plan after stimulus plan, which is watering down finances as well, and weighs on the yen as well. So for me, nothing's changing. I do think we will have a retest at least of 150 or just above. Why not the highs, and why not much higher later? I don't know. But the first level of alert is 145, 145 and a half. If ever it would go really down below there and hold below there, then we could start to talk about a real reversal. But until then, sorry, until then, I'm not going to say that dollar yen is capped or is ready to reverse, and we're seeing it on other stuff like euro yen also came off its highs, but we're still in a gradual move up here, and we don't hang towards the low of interventions. We hang towards mid to high after the post interventions. That means that the market is still not ready to start looking at the other side. Otherwise, we would be drifting slightly lower and then start to fall off the cliff later on. Right now, it's nothing of the likes is happening, and we see that in all yen crosses basically. Yeah, let's have a look at a few different ones here. Aussie dollar, we have been going up and down through this 63, 50, 60, went up to 64, which was a 61.8, and then rejected strongly. But there is traffic, and there is really a lot of traffic, and I would be a bit cautious ahead of the FOMC anyway, to get too bearish on it right here and now. So I do think we are also in a range there. We could see a little bit lower again towards the 62.5-ish zone, in my opinion. But I'm not going to be I'm not yet a major Aussie buyer. But imagine China starting to reopen. Commodities may start to rise again, and this one should be a beneficiary, despite a slightly more dovish RBA than the rest of the central banks right now. And I think that's the reason why we can't hold spikes in the Aussie right now, is that two reasons. The RBA is a little bit on the not dovish, but they are cautious now compared to other central banks, and China is not really fully reopening yet. So the commodity sphere is going up and down, but can't hold real beats as of yet. Keep, of course, a close eye on what's happening in the copper market and stuff, for what's going on in the Aussie dollar. So I think range, respect the 63, 50, 60 once more. There's a bit of a support around 63. The figure, if that would not hold over the day, 62.5 probably is where we are looking at. So you've got like the big figures in the 50s. I think it's roughly the same on the Kiwi, but I'm leaving the Kiwi alone for now, because I've really got no view. The RBNZ seems to change views pretty rapidly, and makes the market change view as well pretty rapidly. So there's a 56.60. We're not far off it. Below there, 56.25, 56.20. Above there, similar thing as we've seen on the Aussie. A spike even went above the trend line here, but it didn't last. It's back below the 57, 50.60, and now we are eyeing supports again towards the mid to low 56s, and I think we're in a range until FOMC probably, or we see clearer on what's happening on the commodities front. Just looking at some comments, but that's okay. The one that is being traded as well in the room is this Euro Aussie. We've had several attempts to break these highs around 157, but it's capped. We're back below 156.5. Is a little bit of a little bit of a temporary temperature judge, and we are back below. So we're trading back towards this. We traded back towards this horizontal support, and we are yo-yoing. That's really my idea still for this week. On anything really is that we are going to be in yo-yo land. So get your levels a bit sorted. Look at what the market is trading, and then just join the party or sit on the sidelines until we see more clear pictures in everything. But in the meantime, there's tradable ranges there on several crosses if you don't like to trade dollars. A quick look at what's happening in Scandiland. Despite what the Norges Bank is selling Norwegian kroner every day, Norway is doing a little bit better than what I expected, albeit we're in ranges, right? 10.30, 10.28, what I was talking about is support on the euro NOK, and then levels of 10.45, 10.47, bit of resistance there. I'm a little bit undecided because oils are also doing the yo-yo after what OPEC decided. So we are finding bids in the Norwegian kroner on dips, but equally we're finding sellers, and that may have to do with what Norges Bank is doing. I'd love to see a bit of a washout down to those lows again, below 10.30 on the euro NOK, and I'll perhaps be interested to buy some. Dollar NOK, pretty much the same picture, and as you see, I've let it go a little bit. I've let the market trade because I wasn't really convinced about anything there. But this 10.40, 10.39, 10.42 zone on the dollar NOK is a pretty good support in my opinion, and I think we should respect that. I'm not very happy about this triangle, to be honest. Seeing the volatility that we can see in the Norwegian kroner, it's tough to trade off trend lines where we only have like a couple of touch points on there. So I'd rather go with the FIBs and levels that have shown up before on this one. The emerging markets, dollar rand still firmly in this channel, which I've been showing a couple of times. It's quite strange that dollar rand did not really benefit much of the dollar shakeout, and that's probably due to the rolling energy cuts blackouts that we see in South Africa as well. So it's a bit tough to keep your economy turning on speed if you don't know whether you're going to have energy to make it run in the next hours. So that's what's still weighing on the rand, in my opinion, despite being a high yielder. This is what I'm really staying out for now. But the only thing I can notice is that we are holding every time we touch the support line. Last but not least, the MEX. That's perhaps a more interesting one. And we know Gregor went short around here, very nice, around the 2015, 2016 zone, very nice. And we are now coming onto an intermediate support. It's intermediate, I think, because to me the big support zone is going to lie around here, which is 65.75. If it breaks down there, then dollar MEX really will have room to go lower again as well. We will see what's happening as well beginning of November, because we have the FOMC on the 2nd, and then we have Banxico on the 10th of November. They did indicate that it might be the last time that they go copy what the Fed is doing, but then if the Fed themselves signal that they might slow down a bit, they will still do the same. So the effect on the MEX may still be of a relatively positive one. For the time being, we look, it's a big traffic zone. People are trading it up and down inside those this 1% basically. So respect it, but I think if we see a break, there is a chance to go and visit 1970s. And then, well, the other one, it's a bit of a standstill right now. Yeah, 1970s already capped. Still hoping that at one stage we can revisit here, perhaps on the ECB. Who knows? Towards the 1990s to add. But for now, I'm just jobbing it around, trying to sell up small rallies, buying back the bits. But it's really, there's not that much to do. Looking at a few questions. A quick word on those CNH gold metals relationship. As Ryan was already hinting, it's going to be very important to see when China reopens really, because then we may see the correlation get perhaps a bit stronger, but it may get stronger with the commodities rather than the metals, although they will start to re-import again. So yeah, the correlation is there, but for the time being, I would call it a more opportunistic correlation than really a de facto, how shall I say, economically driven correlation right now. A bit similar with what's in the yen. A lot of people talk about yen and gold correlation. To be fairly honest with everybody, I've never traded it, and I think it's a bit of a correlation of opportunism than anything else. And with that, I'm looking at the Q&A. Yeah, okay. I'm not going to talk about any politics in here. Ryan, I'm giving it back to you. I really don't have a lot else to say today.
Yeah. Okay, no worries, mate. Thanks. Yeah, that is a situation. Sometimes we do get these market pauses. You know, we'd all love to come on the show and say, oh, yeah, you know, Aussie dollar's going to ramp 200 pips on this level, that level. But sometimes this is what markets give you. Bit of calm and collectedness. So you just plot your levels, maybe trade the shorter term ranges. You know, they're giving them nicely in euro, dollar, for example, 99's your level. Aussie dollar, as Kay's mentioned there, and I've mentioned previously, even gold. I'll show that quickly. Well, actually, I'm going to show you a trade that I got out of this morning. Some of you may or may not recall, I've been short dollar Hong Kong because it's sitting right at the top of their peg at 785. But just with everything going on in CNH in China, and obviously Hong Kong's now under their umbrella, I'm just a bit more wary about any potential shenanigans going here. Maybe they move the cap, maybe they let it go, whatever. It's probably still low risk, but as I say, the risk has ramped up because of what's gone on in CNH, CNY. So I've just taken that off, scratched it for a pip loss up here. I will look to get it back on if things settle down a bit. It's a play against the band. You've got the backstop of the HKMA, the Hong Kong Central Bank in effect. But it's been sitting up there for a while now. So I'm just covering my risk, if you like, on that one. But yeah, otherwise, you know, when you get these quiet moments, you don't want to get in positions. You know, there's no point getting in a position thinking it's going to, you know, rally 200-300 pips, depending on obviously what currency you're looking at or asset, because we're going to find that ranges are going to hold until we get the decisions made from these big events. You know, gold was holding this 1641. Now it's dipping under again. So, you know, moving between the lines on something like that gives you those opportunities if you want to play the short term. You know, that 1617 level, big solid level, looking like a decent double bottom against that fib. That's your marker. You know, if we get a move down there, you're looking for something to do, there's nothing fundamentally changed, well, that's when you start trusting your levels, and you trade them accordingly and manage your risk. Similar pictures as you know, as Kay mentioned in Aussie dollar. I am looking to pick up more dollar shorts. I still think we're nearing the possibility of seeing a top in the dollar. I was running dollar yen shorts, a bit of a longer term build from that. I was short from 144.74, I think, all the way up to the 150s, and then I used the intervention on Friday to basically get out of that position because it was not looking good. But I'm looking to maybe scale back in again. Similarly, going to keep my risk small. I'm already long Aussie dollar as one of those plays for the longer term. It's playing ball for now, i.e. it's not going down anymore. So I am still feeling that the dollar is going to find some sort of top, because I can't see much coming along that's going to make the Fed more hawkish than what they are now. But I'll be driven by the data, like they say. So that's my view on those things. Yeah, in the meantime, folks, just take it easy. You know, don't go out on the limb. Don't get caught in the middle of the ranges trying to, you know, jump on something that's going to sit there doing nothing. Karen, am I still in my pound long? No, I'm out of that. I was out of that on the break of 113 yesterday. Gave a little bit back on. I made a bit, lost a bit, made a bit, lost a bit, gave a bit back at the end. I wanted to see some follow through on cable if Sunak got the premiership. That hasn't happened, so I'm off that boat for now. I think the pound could gain further. Maybe the dollar isn't the one to potentially play it against, but now all eyes are on this October 31st fiscal package and then what it means for the Bank of England. What we do know is that the risk premium, if you like, that we saw from the last 2 weeks that caused all the wobbles is coming out the market now. You can see 10-year gilt yields continuing to drop, you know, heading below the levels that they started kicking off over the fiscal package. So the risk is still ebbing there, but we need to see what happens at this 31st fiscal thing. If Sunak turns around from tax cuts to tax rises, a more austere switch, if you like, in policy, or stance in policy, that's going to be viewed the market maybe in two ways: on positive in the fact that he's going to have finances under control, but negative in that it's going to mean potential reduced activity because he's tightening the leash on finances. So that's going to be upcoming, but on that trade, yeah, I'm out of cable, and for now, no real interest in it for the moment. But I will keep watching other pairs like Euro Sterling. So let's call it a day for today. Thank you very much, Kay and Stel. I know Stel's had to dip off. I shall thank him in the back areas. Have a great day. Look out for the data today. We've got US consumer confidence. Within that is the CPI expectations. Keep an eye on those numbers, particularly with the Fed coming up next week and the market trying to guess what they're going to do. So any real softness there is going to add to the PMIs and the negative data. The market might start to be less hawkish, if you like. Anyway, that's for later. We'll discuss that tomorrow on the show. Thank you, K-Man. Thank you, everyone. See you all tomorrow.
Thank you, everybody.